Well, with NVIDIA earnings out, investor attention eventually is going to turn to Jackson Hole over the next few hours, especially with the sharp move in bond yields that we've seen lately. Joining us now with a preview of what to expect is former Council of Economic Advisors Chair Jason Furman. Jason, welcome. So you would argue that the Fed doesn't have to get all the way down to 2%, but does need to get below 3% and stay there for 6 months before it can change the language. So you wouldn't expect to hear any dovishness on that front this week?
Yeah. So first of all, there's a difference between what I think the Fed should do and what I think the Fed will do. They will be completely focused on inflation. That's the side of the mandate that's out of whack. What they can't do is tell us anything about their policy, in that they don't know what they're going to do with interest rates, because at this point, they really are very data dependent. So I expect them to stress that as well.
So if you expect that perhaps the Fed won't have to get all the way to 2%, how would you position yourself differently as an investor right now versus if you think, they really do?
Right. Right now, if you look at break-evens, bonds are priced as if inflation is going to get back to 2%. I think that's an overly optimistic reading of the data, where part of the low inflation we've had lately, I think, has been good luck and isn't necessarily sustainable. And I think that is reading into the Fed more resolve than they might possibly have. So in some sense, people are looking at these high bond yields right now, and you add in some extra expected inflation, you could see yields going even higher at some point.
So do you think the Fed has to sound like there's more than one hike ahead?
I think the Fed should be preparing everyone for more hikes. And look, it's always easier to surprise people by saying, hey, great news. The economy did better than we thought. We don't need to raise rates like we thought we did. So I think they have been appropriately, since the last Jackson Hole, in the mode of hoping for the best, but preparing for the worst. And part of the reason the economy is coming in better than people were expecting is that people got their hopes down. And I think that was the that was the right way to do economic policies, is just not to do wishful thinking.
Now, the hopes are down in China for a different reason. How much is that going to affect the U.S. economy and the rest of the world?
We'd be better off with a stronger Chinese economy. I don't think we benefit when the world's second largest economy is going into the types of difficulties it's going into. And it's totally unnecessary what China is going through. There's very simple policy remedies for an economy that has low inflation and slow economic growth, but they don't want to do it. Instead, they're engaged in denial. They're hiding the data. They're not taking the obvious steps. And that's going to spill over, not in a huge way, but it's a mild negative for the U.S. economy.
And the UK and Europe, how are you feeling about them? Quickly, if you can.
They're in a more difficult situation than us. They have more inflation than we do, and they have slower economic growth than we do. So they have both sides of the soft landing are threatened for them in a way that hasn't happened here, at least so far.